Greetings, everybody. Welcome to the Liberty Call. It's Tuesday, November 29th, 2022. I trust everybody's having a fantastical day out there in the interwebs. Better day in the markets today. Certainly not as down as dramatically as yesterday's close, but still some red on our screen here domestically. But looks like the rest of the world kind of bounced back. So definitely the Asian markets definitely had a major recovery, even with all the what's the word I want to use? Conflict over in China right now. So we'll see what happens there long term. But crazy times we're living in, crazy times. All righty. Well, if it's your first time watching the Liberty Call, please give me some big old thumbs up, likes, shares, subscribes. I would greatly appreciate it. And if you hit that subscribe button, you get this daily news show from me, a real financial advisor, anytime you want. And you get a little pop-up on your phone. It's pretty cool stuff. So anyways, let's go ahead and dive into the numbers and see how things turned out today. The Dow Jones finished the day barely up. It was up 0.01%, closed at 33,852. The S&P 500 was down 0.17%, closed at 3957. NASDAQ was down 0.59, closed at 10,983. Small caps were barely up, 0.05. The VIX fell today, which is a little odd, seeing that the S&P 500 was down. VIX fell 1.44% to 2189. Canada was up 0.28. Brazil was up 2.02%. Mexico was down 1.75. Let's hop across the Atlantic. Germany was down 0.19. UK was up 0.51. France was up 0.06. Eurostoxx was down 0.03. Netherlands down 0.38. Spain flat at 0. Let's see. Italy up 0.1. Switzerland down 0.76. And Portugal up 0.2. So kind of a moderate day across the European markets. Moving further east, the Russian markets, MOEX was up 0.36. The RTSI was up 0.56. And headed over to the Asian markets overnight, Japan was down 0.48. Australia up 0.33. In China, the Shanghai was up 2.31. The SESE component up 2.4. The China A50 was up 3.84. DJ Shanghai was up 2.53. And the Hang Seng up, 5.24%. That's a huge number. And the Taiwan weighted came in up 1.05%. All right, so that's everything as far as the markets for trading day, November 29th. So like I said, things aren't terrible here, but they're not great. I mean, anyone who's, if you stick your head up out of the gopher hole and look around, I mean, it's like, well, still a lot of help wanted signs. Things are more expensive. The government that I detest continues to get in the way and make life harder, especially for, things like oil exploration and things like that. And, we could have, much cheaper energy, but, those in charge seem to think we should have windmills and unicorn farts power and everything, but I don't think it's going to work out that way. All right, well, let's go ahead and read through today's market recap. S&P 500 slips as Apple-led dent in tech bites. All right. The S&P 500 struggled for direction Tuesday as an Apple-infused stumble weighed on tech, just as Treasury yields continue to rise amid data showing underlying strength in the consumer. Apple fell 2%, adding to its losses from a day earlier as investors continued to fret about the impact from a COVID-led hit to iPhone production in China on the tech giant's performance. TF International Securities analyst Ming-Chi Kuo flagged, quote, significant downside risk to Apple and iPhone supply chain, end quote, estimating a shortfall between 15 million and 20 million iPhone 14 Pro and iPhone 14 Max or Pro Max shipments owing to the Xinjiang iPhone plant labor protests. And if you haven't seen them, they're throwing barricades, they're beating it's pretty wild. I mean, granted, I'm only seeing what's coming out of here on Fox Business, and they're actually playing some of that right now. It's kind of like here in America. If we all fought back against this tyrannical government, we'd all be free. But most people just like the status quo. So we continue to be hostages here in this country too. All right, diving back in, Microsoft and Alphabet were also in the red, pressured by an ongoing climb in Treasury yields as data showed that consumer spending, which accounts for about 2/3 of economic growth, remained robust. The Conference Board's consumer confidence gauge rose to 100.2 in November from 100.0 in September, beating economists' forecast for a reading of 100. Quote, confidence data suggests that the Fed needs to continue to push forward with the hawkish policy guidance that they have been delivering for the last few months, end quote, Jeffrey said in a note. Investors will look to Fed Chairman Jerome Powell's speech at the Hutchins Center on Fiscal and Monetary Policy at Brookings on Wednesday for further clues on monetary policy. Chinese technology stocks, however, were in ascendancy as Alibaba and Baidu Inc. rallied amid speculation that recent social unrest in China may force Beijing to ease COVID-19 restrictions. Well, they better do something. Those people are pissed. Energy stocks rebounded from a rout a day earlier amid hopes that OPEC and its allies, known as OPEC Plus, are mulling production cuts at an upcoming meeting next week. APA, Halliburton, and Coterra Inc. were among the biggest sector gains, rising 3%. Railroad stocks were buoyed by reports that President Joe Biden is urging Congress to help break the deadlock in talks between labor unions and rail operators to avert a strike before the December 9th deadline. CSX, Union Pacific Corporation, and Norfolk Southern were up more than 1%. Yeah, it looks like the current administration, all they did was really just pass the buck and push the rail strike issues, out past the election so they could deal with it now. And, if they do indeed strike, it's not going to help things. I mean, things are already expensive. If we then start having shortages in goods and food and things like that, prices will spike again even more than they already are. So, it's kind of like adding a shitstorm on top of another shitstorm and expecting it to turn out good. So let's hope that they come to some sort of common agreement and can get past this. But we'll see. All right, next up, 3 Fed bank boards wanted smaller discount rate. I know I've complained about this a lot over the last 8 or 9 months, where everyone in the financial business, the financial journalists, they're all just wringing their hands. They're so upset that interest rates might go up above 3 or 4%, and to quell the inflation that the Fed caused. It's not like these people are not guilty of causing this problem. But all right, let's go ahead and dive into this quick article. Directors at 3 of the Federal Reserve's 12 regional banks supported a smaller increase in a key emergency borrowing rate than the 75 basis point rate hike the U.S. Central Bank ultimately approved in early November. Minutes of Fed discount rate meetings showed on Tuesday. At meetings held a week or two before the Fed policy rate decision, directors on the Kansas City, Philadelphia, and New York Fed board sought a 0.5 percentage point increase in the discount rate, the minutes showed. Those at the other 9 banks backed a 75 basis point hike, which was the increase Fed policymakers decided on at their November 2-3 meeting. None supported a 100 basis point rate hike, as at least one bank board did before each of the prior 2 Fed meetings. Fed bank boards do not set policy rate, but they do meet regularly to vote on the discount rate, which moves in tandem with the policy rate. Again, it's kind of like taking your medicine, like when you have a cold or the flu, and it's, you have to take antibiotics, and, your doctor gives you a course of, 7 days or 10 days or 14, however long, your doctor prescribes it for. Well, if you've been taking your medicine for, say 3 or 4 days, and hey, I feel better, I'm just going to stop taking it. Well, then, you might have a rebound effect and you wind up sicker than you were to start with. So it's kind of the same situation here where, we need to get inflation way back down. I mean, I know the Fed is targeting, they have their 2% target that they like as a floor, but, we need to, I'd like to see some deflation in the economy for a while and see prices actually come back below where they're at right now and, inch towards, closer to where they were 3 years ago at this time when things were, humming along pretty good. I mean, granted, we had problems, and I'll talk about that and when talking about the yield curve at the end. But we wouldn't have all this inflation if they hadn't printed $5 or $6 trillion over such a short period of time. But hey, what do I know? So I'm just some guy who sits here in the mountains. Let's see here. Ooh, why do I get these comments from all these idiots? So let's block this user, put them in timeout. There you go. You're gone. All righty. Let me get back to where I was. All right. Some good news. Excuse me. Allergies. All right. Next up, U.S. house prices fell another 1.5% in September. So there's some good news for people in the home buying market. Not good if you're trying to sell your house, but, we'll take wins where we can get them. The U.S. housing market was firmly on a downward path by the end of summer as selling prices fell for a third straight month in September, according to new data out on Tuesday. S&P said its index of prices from 20 major metropolitan markets across the country fell another 1.5% in September after having fallen 1.6% in August and 0.8% in July. August's drop was the biggest monthly fall in prices since the Great Financial Crisis in 2008. Again, something caused by government and greedy lenders. But caused by an implosion of the subprime credit bubble. In year-on-year terms, the rise in prices slowed to 10.4%, its lowest since the end of 2020, as the Federal Reserve's sequence of interest rate hikes have sharply reduced the amount of debt that most families can take on to finance a home purchase. Only 5 months ago, prices were still rising at an annual pace of over 20%. The price index compiled by the Federal Housing Finance Agency also reinforced the pattern of a market fast adjusting to tighter financing conditions, saying its measure of single-family home prices rose 11% on the year through September, down from 12% in August. In 1/3 of states, the metropolitan markets, prices are now rising at a rate less than 10% a year. However, FHFA reported a modest 0.1% rise in prices from August levels. According to FHFA, housing prices have risen on a year-on-year terms each quarter since 2012. Other data released on Tuesday indicated that high inflation continues to take its toll on consumer sentiment. The Conference Board's index of consumer confidence fell to 100.2 from 102.2 in October. However, the decline was less steep than expected and leaves the index still some way above its July low of 95.3. So again, some good news that, prices are starting to fall a little bit and will probably stabilize. I don't see them coming back down to 2019 levels, but again, things just get more expensive over time because we increase the money supply every year, and that makes everything else more expensive. So I personally would like to see a more sound money type of world we live in, but in this current iteration, I just don't see it. And you can see my boy Jake over my shoulder. He's just not real excited about this either. All right, one last article here. Yield curve inversion reaches new extremes, and this comes from the Wall Street Journal. Woo. Yields on longer-term U.S. Treasuries have fallen further below those on short-term bonds than any time in decades, a sign that investors think the Federal Reserve is close to winning its inflation battle regardless of the costs to the economic activity. A scenario in which short-term yields exceed long-term yields is known on Wall Street as an inverted yield curve and is often seen as a red flag that a recession is looming. Again, I could have told you that a long time ago, but no one listens. Yields on treasuries largely reflect investors' expectations for what short-term interest rates set by the Fed will average over the life of the bond. Longer-term yields are generally higher than short-term yields because investors want to guard against the risk of unexpected inflation and rate increases. At a basic level, an inverted yield curve means investors are confident that short-term rates will be lower than longer-term rates than they will be in the near term. Typically, that is because they think the Fed will need to slash borrowing costs to revive a faltering economy. Yield curve is more than just a little bent out of shape at the moment. Last week, the yield on the 10-year U.S. Treasury note dropped to 0.78 percentage points below that of the 2-year yield, the largest negative gap since late 1981. And we know what was going on in 1981, lots of inflation. At the start of the recession that pushed the unemployment rate even higher than it would reach later in the 2008 financial crisis. Still, many investors and analysts see reasons to think that the yield curve may presage warning inflation and return to a more normal economy rather than approaching economic disaster. I would lean more towards the economic disaster. Investors, he added, believe the Fed does have credibility. They have no credibility in my mind. These are just crooks. Ultimately, the Fed will win this inflation fight, and in the meantime, we have to bear higher short-term interest rates. End quote. Notably, the yield curve has become more deeply inverted in recent weeks, largely to good economic news. Really? Well, let's take a look at the yield curve, and let me make it a little bigger so you can see it. This is what it looks like today. On the left is the short end of the of yields, 3 months, 2 years, and so on. And all the way over here is 20 and 30 year bonds. So, and you can see that it's higher on the short end of the curve and lower on the long end of the curve. And if we go back through time, this is what it looked like May of 22. This is what it was about a year ago at this time. This is what a normal yield curve looks like typically. It starts, kind of a, what's the word? It's been a long time since I've done geometry. Kind of a half of a parabola, kind of swoops up and then levels off when you get to the longer term. But the problem is that on the short end of the curve, we were just at zero. And, normally, and if we go back further through time, actually back in 2019, we can see that the yield curve had inverted again. And, at the time I was calling for, hey, going into 2020, we're probably going to have some sort of a bear market, potentially recession. Who knows? It had been it'd been well over the 7 to 10 year time span that we normally go through those sort of cycles. And, but COVID came out of nowhere and mysteriously gave an excuse for the government to print a bunch of money and cover up the problem that was going on, that business, needed to go through a down cycle to flush out all the malinvestment, but that we know didn't happen. So let's go back a little further through time. Again, this is what the yield curve normally looks like. And we go back, and we see it flatten out again. When was this? February of 2007. What happened in the next year? We had the mortgage crisis and all the problems that occurred there. And so let's go back further through time. Again, normal curve on the short end, much better, but much better rates at this point. But again, it curves in a what I would call a positive direction. And if we keep going back further to the furthest day that we have on this chart, hey, look, it's inverted in November of 2000. What happened? The dot-com bust was right around the corner. And so this is a very good tool for measuring, like I said, for measuring or kind of giving you some guidance that, hey, you need to be a little more careful. I know I was being extra careful going into 2020. I was right on one end, but what I didn't see happening was the massive amount of money creation that occurred later on that year. And that, caught me off guard. I mean, I'm honest, these things do happen. So, all right. Well, that's everything I had for today. Had a little bit of a lesson on yields and the yield curve, and we talked about the housing prices falling, and what the Fed is potentially doing here in the near future. So, all right, well, that's everything I had for today. My little buddy back here, he wants to go play ball, and that's my collateral duty after I finish work every day, is to go make sure he's efficiently tired or very tired after a long day of sitting here on the floor and bugging us to make sure he stays fed. So, all right. Well, if anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And I hope you all have a great evening, and I'll see y'all next time. Adios.